All right, good morning, good afternoon, or wherever you may be. I'm not sure what time. We have a lot of people, a lot of different places listening to a great webinar we have today on disruptive real estate market trends for 2024. The great guest speaker. It's been a little while since we had him on, but I'm really excited to have Neal Bawa back on today to join us and talk about some of these trends. We'll get into more about Neal in just a few minutes, but really excited for the webinar. A lot of good data you're going to get. If you're someone who is data-driven, this webinar will certainly be for you today. I am your host, Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. Been with the firm for a number of years, helping individuals use their retirement accounts in ways that they are getting their money outside of the stock market and into other investments that they understand they can control. A lot of those investments centered on real estate, which again is going to be the genesis of our topic and our conversation today. If you have questions about self-directed IRAs, you can reach out to me. Here are my numbers on the screen, as well as my email address and our website. Please don't ever hesitate to reach out, whether it's you're looking more information about self-direction or just general IRA questions on distributions, contributions, etc. Always more than happy to answer those for you. For those of you who are unfamiliar with Advanta IRA, we've been around for over 20 years doing only self-directed IRA administration. Our only business is helping individuals who have money in IRAs, have money in 401ks, invest in those assets like real estate, precious metals, private loans, private equity, all the different things that you can do with those accounts. We currently have over $3 billion in assets under management, over 12,000 active clients, and we really pride ourselves on our customer service and also on the educational offerings that we have. The webinar we have today is one of two that we're doing this particular week, and in most weeks we have at least one or two webinars on a variety of different subjects, all of which are categorized and archived on our YouTube page. So if you're listening to us live today, you're going to be able to have the ability to ask questions of myself or Neal as we go through the webinar. If you're listening to the recorded version, you certainly can reach out to either Neal or myself afterwards. And if you're looking for other information, again, our YouTube page has all that archive of all of our past events as well. For those individuals who are unfamiliar with self-directed IRAs, very quickly, the reason you haven't heard about them is simply that most IRAs and 401ks are held by banks and brokerage firms who only are offering you those products that they sell, the only products that are available on their platform. The IRS regulations allow you to invest in a quite a broad range of investments. Anything, as long as it's not life insurance or collectibles, those are the two prohibited investment classes. If it's not one of those two classes, you can use your IRA to make those types of investments. So the brokerage firms, the banks, limit you to stocks, bonds, and mutual funds because that is what their business model is predicated on. But you certainly have other choices. And I know that a lot of people on the call are already self-directing or looking to self-direct, so you're already aware of this information. But for those of you who are new, that's why you haven't heard about this before. And really, I think one of the reasons why retirement funds are such a good capital source for real estate. Number one, it's a different source of cash to use. So someone who's already investing in real estate personally, you can use your IRA, you can use your old 401k funds to take advantage of another investment opportunity rather than leveraging other assets. It's just other cash that you have access to. Hopefully you're looking to earn a better return. Obviously, depending on where your funds are sitting now, they may be in the stock market, which has its ups and downs. Maybe you're just sitting in a CD right now because you're scared about putting that money back into the market. Putting it into real estate, into a cash flowing, appreciating asset can get you a better rate of return on an annual basis. Obviously, that's the goal of retirement accounts, is to grow them as high and as quickly as possible. There's no outside approval needed. These are your funds, your IRA, your 401k. You just decide how much you want to use and what types of investments you want to make. And I think especially as we talk about, we're talking today with the mad scientist of multifamily, Neal Bawa, for those types of investments, real estate, for a lot of the longer plays, whether it's a long-term rental property, you're investing in a real estate syndication, where that money is going to be tied up for 3, 5, maybe even 10 years. Most people don't plan on touching their IRAs or their 401ks, until they hit that age 65, 70, when they are retired. They might have a personal savings account that they want to have. They have for emergencies, medical bills, unforeseen circumstances. You want to have access to that cash quickly, but most people aren't planning on touching their IRA or their 401k for several years anyway. So it's not a problem to lock up the IRA into a real estate investment for the next 5 years because you weren't going to touch that cash anyway. But your personal savings, that's the money maybe you want to keep a little bit more liquid. Now, the types of accounts that can be self-directed, any type of IRA, whether it's a traditional or a Roth for individuals. If you're a small business owner and you have a SEP or a simple IRA, those are great plans as well. Any type of IRA, if you're looking at your account statement, I'm not sure if I can move this money, can I self-direct it? If it is an IRA, you absolutely have the ability to port that money over into a self-directed account. Also, any former employer plans, old 401ks, old 403bs, old TSP plans, those monies can be rolled over into an IRA and then used for a self-directed investment or the kind of things we'll talk about today. The only really restriction when it comes to being able to self-direct retirement funds is current 401ks. So if you are involved with your 401k, your retirement funds, or with your current employer, they can restrict your ability to move that money while you were still employed there. So that is the one restriction. Any type of IRA, any type of former employer plan, you can use that money to open up all the different investment options that are possible. And again, we're going to focus on real estate today. I'm about to bring on our host here in just a minute to get into the great information that he's going to share. But the real estate realm, again, probably 70 to 75% of the assets we hold under management are real estate in nature, whether it's a single family property that's being held for, it's a rehab project, maybe it's a long-term rental. The syndications, mainly a lot of them are commercial multifamily. We see people syndicating car washes, self-storage facilities as well. You can lend money from your IRA and have your loan secured by real estate in the form of a mortgage. So all of these investments, the checkbook LLCs, the raw land, the tax liens, tax deeds, all fall within the real estate realm. And I think when you're investing in real estate, anyone who does so would agree, you have to understand the market trends that are out there. What forces are pressing different areas of the country? There may be depending on where you're living, there might be things that are affecting your community, your rental, especially your real estate investment community, more so than it would be in other areas of the country. We are a very large country, 50 states, 50 different economies. Some of them have things in common, some of them don't. And so, like I said, different market forces will affect different areas. And that's why I really am excited to bring Neal Bawa to us today, the CEO of Multifamily University, the founder of Grow Capitus, again, referred to as the mad scientist of multifamily. He's a frequent podcast guest, speaker. And like I said, Neal's presentations are always chock full of a lot of great data, which I'm really happy to have him share with you today.
Well, welcome everyone. My name is Neal Bawa again, and I work for Mission 10K, that company over here, and Grow Capitus. These are two data-driven real estate investing companies, and our topic today is real estate trends for 2024, second half, and also the best cities to invest in. We're going to dive deep into the numbers. We're going to give you a clear picture of what's happening. So let's get started. For those of you that don't know me, well, I'm a quirky and opinionated data scientist and a technologist who buys and builds large projects. And our portfolio of 31 properties worth $1 billion. Over 1,000 very data-driven, somewhat nerdy investors have trusted us with their money. And we do all kinds of things. We build brand new buildings. This is one in called Coyote Creek in Ohio. We also buy buildings. So this is one that we bought and improved. Sometimes we buy Class C buildings, so much older buildings. So this is one that we are currently buying. We recently bought and improved. We also do high density apartment complexes in downtown. So you're seeing one of those. And then from time to time, we dabble into student housing. This is in Buffalo downtown. We also do townhomes, and you'll hear more about that at the end of my presentation. I really enjoy building townhomes. So this is about half of our portfolio, and we use data science to invest in 8 different asset classes, with multifamily being the largest. Our investors love what we're doing. Here's Jennifer. She's a super experienced investor. She compares us to much larger companies with more projects, and she thinks that we come out ahead. All right. You've already gotten a disclaimer, so all I'd say is that this is a reminder that this webinar is for educational purposes only, and just because we're sharing our personal opinion, it doesn't mean that you're guaranteed to make a fortune in real estate. Okay, great. Let's start this 2024 trends with what the Fed's take is on the economy and financial markets. And so we'll spend 90 seconds on what the paper pushers at the Fed are saying. Now, we'll start with Eric Friedman. He's Chief Investment Officer at US Bank. And the soundbite from him is representative of what a lot of people are feeling, right? And that is that the Fed will have to start cutting rates before inflation drops to 2% or below 2%. Why? That's because there's damage to the economy from such high interest rates that's not immediately visible. Now, if you've been following economics, you know that the last 30 days, the economy is definitely slowing. Inflation is definitely reduced, so it's gone down to 2.7%. Open jobs have reduced, and manufacturing is now in an 18-month decline. So we are seeing the economy substantially slow over the last few months, and the Fed itself believes that. Keep in mind, the Fed is predicting that inflation will fall to 2% by 2026. And while the Fed's track record on predictions is not good, I want you to keep in mind that their inflation predictions are actually a self-fulfilling prophecy. Because if inflation doesn't come down, they boost quantitative tightening or they raise interest rates until it does come down. So in a way, they achieve their number by simply manipulating the market liquidity and interest rates. So it's very important for investors to understand that the Fed believes that inflation will be at 2% in 2026, and they're in a position to take corrective action until it drops to that level. And the Fed has now projected that 2024 GDP growth for the United States should be 2.1% for the year. And you note that, please note, they bumped this number up from 1.4%. So they have a growing level of confidence that we might avoid a recession. And with the unemployment rate at 4%, 24 months after a rate hiking cycle began, it's fair to say that the US economy has proven to be incredibly resilient. And when everyone, including the Fed, expects the economy to slow, and the job growth numbers, the unemployment numbers, they're simply not consistent with a recession in the second half of this year. So that's good news. And there's also challenges for banks and for CRE, as you're going to see. So our first prediction that we're going to make today is about the economy. We were wrong last year. We thought a recession was inevitable. And based on very strong evidence, we have to change our mind. We think the US economy is going to have a soft landing this year, even though the second half of the year to you will feel close to a recession, right? So this is Marcus and Milichev's predictions, but a lot of the predictions that we've studied are similar to this one. So yes on soft landing, our first prediction. And a lot of economists are saying things similar to what Freddie Mac is saying here. As you can see, Sarah Hoffman says that the economy is on track for a soft landing, but will be bumpy throughout the year. And her prediction on multifamily, the largest commercial real estate asset class, is about additional strain from new supply and these high interest rates, but she expects multifamily to retain its numero uno, its number one status as a favorable asset class. Second prediction is about the labor market. So the Feds are doing their job. So each month we see job openings going down. This chart needs to be updated for the last couple of months. And the path has been exactly downward. So it's exactly, that arrow is showing what's happening in the last 2 months as well, right? So wage growth is cooling. So wage growth is now dropping closer to 2%. And that's why we think inflation is going to continue to cool. Our next prediction is about the unemployment rate, and we actually have to hit humble crow on this one because a year ago, we thought that the unemployment rate would be around 4.5% by the end of 2023, and actually is taking a lot higher. So unemployment is going up, but it's going up a lot slower than we thought. But by the way, by historical levels, we're at 4% right now. That's an extremely low rate of unemployment. So do expect unemployment to trend upwards in 2024, and basically start 2025 at right around this 4.2% level. Our final prediction is about the growth of the economy. This is commonly referred to as GDP. As you can see from the section on the right here, growth did impossible things in 2023, accelerating pretty much throughout the year, even though interest rates were going up. But now, analysts do expect the economy to slow down a bit in 2024, you see here. And the second half is going to feel like a recession, but we expect that the economy will accelerate throughout the year in 2025. All right, I'm done talking about the economy. I'm now going to talk about real estate. First, I'm going to talk about commercial real estate, and then we'll get into single family. Lately, there's been a steady drumbeat of bad news about real estate, especially commercial, apartment, and office real estate. So let's dive into the numbers, especially delinquency and default levels, and also compare the multifamily and industrial and retail and hotel and other asset classes. On this line here, orange line, you can see that the delinquencies for CMBS, this is a very popular kind of loan, are actually pretty low at 4.7, right? So you can see that they're ticking up a bit to 4.7%. I expect them to go up a little bit further, but please go back and look at what the number was after the financial crisis, so 10.3%. So note that this chart is showing all of commercial real estate, right? So everything. So in aggregate, today delinquencies are lower than they were in the middle of 2017 and much lower than 2011, 12, 13, 14, or 15. Now let's look at some predictions, right? So I couldn't, I found some predictions from Fitch. This is a rating agency for all of commercial real estate. And so I'm sharing them with you. Fitch says that multifamily CMBS delinquency is forecast to be a shockingly low 1.3% in 2024. And then it goes up in 2025, 1.5%, which is still a stunningly low number. Just so you understand how low these two numbers are, look on the right at the office delinquency number, right? This is for office. We're already at 8.1%. So this is 7 times higher roughly than it is for multifamily. Already at 8.1, going up to nearly 10% of all office loans being delinquent this year. So hopefully this tells you the difference between this asset class, apartments, and that asset class, office. Okay, so now let's move into foreclosures. So we talked about delinquencies, now let's talk about foreclosures, right? Here's a look at all of the foreclosures across commercial real estate in 2024. That number is basically much, much lower than 2014 or 2015 or 2013 for that matter. It's rising, you see that, but the total number of foreclosures across the United States, across millions of properties, is 635 so far this year. So once again, I hope this number gives you some sense of perspective. All right, so one quick thing to note, I'll just go through this slide very quickly, is that the majority of foreclosures are in older urban offices. So you see this picture, that's a typical older urban office. And that's where the vast majority of all the foreclosures really are. Nothing else is really foreclosing. Now, a lot of people, and if you've been following the news, you've been hearing about a lot of debt, CRE debt, basically loans are maturing in 2024. So what we did was we put them basically by property type here. And you can see how many loans are maturing. And then this slide, this piece here, it shows what lenders are doing about it. So because office is in a very, very bad place, very, very bad place, almost half of those office loans, they kicked the bucket down the road. They kicked the bucket down the road and said, hey, we don't want these properties back. We don't know what to do with them. We'll just give you an extra year. They did the same for industrial and hotel and retail. And to some level, retail's in a very good place right now. But for multifamily, they haven't deferred basically any loans. Why? Because multifamily is the most liquid. So today, if somebody defaults, the bank's going to turn around and sell that property in 45 days, and they're going to do really, really well in terms of selling that property. So the bank's like, yeah, you guys might lose your money, you might lose your equity, but I'm going to sell this property very quickly. So I'm not going to bother to extend any of your loans, which is a real vote of confidence for multifamily, because clearly they are not feeling that way for office or any of these other asset classes. Here you can see retail is actually doing shockingly well. So what happened is, starting about 2009 and 10, we started hearing about the retail apocalypse because of Amazon and things like that. So retail started to build a lot less. You see these bars are a lot smaller than these bars. So as basically over time, as completions went down, there was a lot less space coming into the market. And because of that, vacancy rates have dropped pretty much to all-time lows, and rent growth is also on the upswing. So very surprised about that for retail, because I wouldn't have thought that it would be here. What about hotels? Well, their occupancies are really doing well. They're back almost to the pre-COVID level, and their average daily rate, wow, take a look at this. This is where they were average daily rate in just before COVID. So right around $130, and today they're up to $160. So average daily rates are up, phenomenally. For both full service and limited service hotels. So really doing well. The hotel class is doing well. But the one that's doing the best, really, in my mind, is industrial. And that's because of both the Amazon effect and because of the tens of thousands of data centers that we will need to build for artificial intelligence or AI. So there's really no delinquencies available because there's very little space available in the US for industrial. So bottom line is when you combine this all together, the truth is that CRE stability is in sight. And what's happening with the media is typical what happens in the media. It's overblown, right? So the evidence is just not showing up in the property fundamentals, in the delinquencies, in the foreclosures. It's not there. Now, some of the stuff on the TV, it also talks about whether this commercial real estate distress and potential, all these loans coming due, could it take down the banking sector? Well, let's take a look at that, right? So there's about 4,000 banks in the United States. And of those, this company called Claros Group, right? They did an analysis, and 282 of these banks basically have some exposure, significant exposure. So there's Claros Group did this analysis, right? They came up with this list of 282 banks. And these are the ones that had CRE loans making up more than 300% of their total capital. Remember, banks lend out a lot more than the capital that they have. So, on the left side, you can see that in this list, and the list is divided into 3 sections. These are very small banks. These are sort of mid-sized. These are large banks. There's only actually one large bank in this list, and that is New York Community Bank. Now, the FDIC, which insures banks, right, has its own problem list. So we found the problem list and we took a look at it. And basically, the first thing you should know is this blue or black line that's running from left to right. That's the number of banks in the list in that troubled list. And right now there are 52 banks in that list, right? So, and this bar shows the assets of those banks in billions, right? So basically their total assets. So as you can imagine, the FDIC is a lot more worried about large banks in the problem list than the small banks in the problem list. So it's very good to see that there are firstly only 52 banks in trouble. And as you can see for these smaller banks on the right, they're mostly small banks, Now, to independently verify that the big banks are in a good shape, we decided to look at their stock price increases in 2023 and 2024. That was very interesting. The bank in the best position is JP Chase Morgan, right? With only 12.5% of their loan portfolio in commercial real estate. As you can see, Wall Street rewarded them by increasing their stock price by 27% last year. Wells Fargo only saw a bump of 18% because they have a slightly higher exposure to CRA. Relatively higher, but overall they're in a decent place. And then we looked at this bank, New York Community Bank, and you can see 57% of their portfolio, a lot, is in CRE, and Wall Street's been punishing them with their stock declining by 2/3 this year, and they also declared a $2 billion loss. So here's the bottom line, friends, right? And this is good news. Please don't pay attention to nonsensical clickbait on the web. The vast majority of commercial real estate loans are lurking in small banks or are being deferred. 56% in small regional banks with less than 20 billion in assets. None of these banks are systemically large. And what this means is they can't really affect the US economy or affect the stability of the financial system. The only impact is going to be on the shareholders of these banks, and hopefully you don't own shares in any of them. If you do, I would be hitting that E-Trade button right about now. Okay, I'm done with the dense economic analysis stuff. Now for something more interesting, right? Real estate. We're gonna do a quick 2023 feedback. We're gonna go into single family now, and we're gonna get to the business of forecasting single family and multifamily performance in this year and also next year. So single family, right? Single family prices are in a bubble, but this is a resilient bubble. All predictions that single family prices will decline in 2023 turned out to be wrong, completely wrong, including me. CoStar, in fact, predicted a 20% decline, but the home prices actually went up by 3 or 4% in the last year. Now, why do I consider single family to be in a bubble? Well, for that, you have to look at the 3 numbers on the right. Monthly mortgage payments are up a shocking 111% since COVID. I want to point out that salaries have gone up by less than 20% in that time frame. Mortgage payments up by 111. Now, about half of that came from price increases, and the rest came from interest rate increases. So you tell me, with numbers like this, completely out of whack with salaries, why shouldn't home prices go down, right? It is a bubble, right? But it's a very resilient bubble. And it's so resilient that despite these astonishingly high interest rates, 7+%, nobody's predicting a decline in home prices in 2024. Even these red bars on the left that you see from Realtor.com and Zillow, they've barely moved the needle on home prices, right? Low unemployment, you got high wage growth, 8 million jobs are open. So no one's predicting that the housing bubble is going to burst this year. And it's all because of one thing, the lock-in effect. So let's study that. So let's say you're a homeowner, you purchased your home 5 or 6 years ago, it's been appreciating every single year, and right now it's worth about $1.2 million. And you have about $350,000 in equity built up on your house. Now in 2021, you decide to refinance and you got a great rate at 3%. And that's going to put your monthly mortgage right around $3,600, principal and interest. And then you find out that your wife is pregnant. You're going to need an extra bedroom. So you go out, you check properties, you see that homes with that extra bedrooms are going to be around 1.5 million. So you crunch the numbers, right? Today they're 1.5. So you have about 350K of equity that you can take from the sale of the current property. You can apply it to that down payment. But with the rates around 7%, you realize that even with 350K down through that equity buildup, your new principal and interest payment would be around $7,600. So despite that buildup of equity, your new monthly payment is $4,000 a month higher. That's nuts. Nobody can afford that. And this is why homeowners are staying on the sideline. That's the lock-in effect. And because of that, the home pricing bubble is not bursting and may not even deflate 2 years. And that's leading to a new phenomenon. Millions of forever renters, right? It used to be that 2/3 of Americans, they lived in their own home and about 1/3 of Americans lived in a rental property. But with these astonishingly high prices and mortgage prices and that lock-in effect, we are now seeing middle-class Americans become forever renters. But you can see from this graph, buyers must now earn $115,000 a year to afford a typical home in the US. And that typical buyer only makes $75,000 as of this year, as of 2022. So probably up to 80,000 now. So that gap of $35,000 is almost impossible to bridge. And remember that 115K number that I gave you just now, that's for the entire US. Let's take a look at some of the cities that have job prospects and see what the numbers are like there. In San Francisco, you need a median income of $404,000 to afford a home. $404,000, right? Well, why would I go live in San Francisco when I can go to Phoenix? Well, Phoenix is not cheap anymore. It's over $100,000. Markets around the US that were considered cheap 5 or 10 years ago, also around 100,000. Dallas, 116,000. Miami, 145K. Nashville, 124K. In fact, the only large metros that are near 100,000 now are Houston at 92,000, Atlanta at 107,000. And that's what's driving people to third-tier cities. So we're seeing people move from Nashville to Knoxville, to Chattanooga, to Memphis. People are moving from Phoenix to Flagstaff and Tucson. So as technology allows, smaller and smaller metros take a bigger and bigger share of the jobs. And this migration to ever smaller cities will continue to accelerate. And this is our biggest takeaway from this data-driven presentation. Now, what about multifamily? Well, multifamily, for once, this probably will never happen again, is incredibly balanced. I generally don't say anything like that for the multifamily market, but I want to show you some fantastically interesting numbers, right? Most people at conferences stand up and they say multifamily is still too expensive, and they're probably right. But you know what the renter cares about? They care about rents. And here, the multifamily market has shown an astonishing level of balance. I want you to look at the numbers on the top right in green. Rents have increased by 19.6% since COVID started, right? How much have wages in the United States increased by? Well, 19.7%. So you notice here that rents are going up at exactly the same speed as wages. And there is no better example of balance than these two numbers, right? So balance is the good news. Well, the bad news is there is some, incoming supply, and there's 3,000 or 4,000 properties in distress. So first, incoming supply, right? There's a lot of new apartments. You see this bar very high. Not since Richard Nixon was president has America seen this many apartments coming online, right? So it could be as many as 672,000 apartments delivered. Now, important to understand that the vast majority of supply is in Sunbelt markets like Austin, Raleigh, Nashville, Jacksonville, and Charlotte. These are the markets that are likely to be more impacted, not the national market, right? Not the national market. Now, as you can imagine, there's an impact of this, and that impact is basically that strong supply has led to slower rent growth. So in April, rents only grew by 0.1%. You annualize that, and it's a little over 1%. And that is one of the reasons why we are beginning to see inflation come down in the US, right? Almost a third of inflation is rents. And so now that rents have slowed down a lot because of that incoming supply, we're actually beginning to see balance in the inflation market as well. There are people saying, well, yeah, because of these rents being low and prices being high and interest being high, multifamily is in distress. This is not a great time to invest. And that's a very silly comment because these people are not looking at numbers. For example, where is this distress in multifamily? Show me in this graph. Take a look. Credit cards are distressed. Auto loans are distressed. Home equity loans, single family first liens, single family second liens, CRE non-owner occupied basically. But right down here, do you see apartments? That's the total delinquency rate for apartments in the United States, where so many others like home equity loans and single family loans right here have 4 or 5 times the delinquency. And even these delinquency rates are pretty well controlled. So in my mind, this is actually a very, very good time to buy multifamily. We've seen inflation slow. We might even go into a recession in the second half of the year. So rates will fall. There's no doubt in anyone's mind that there will be a cut now in September. Multifamily deals are discounted. They're 25% off peak, where single family is 6% higher than it was last year. And this rent versus buy paradigm has really shifted, right? So when you look at the average rent and you look at the average mortgage, the difference between them is the highest it has been in history. Bottom line, single family is an overvalued in bubble market. Bubble can't burst because of the lock-in effect, but if that effect will end sooner or later. Okay, I'm going to end this particular presentation with a list of cities. But before I do that, I want to tell you what my life mission is. I believe that what happened with COVID, this massive increase in home prices, this massive increase in interest rates, means that 18 million American families are now forever renters, and they don't want to live in apartments. They want to live in a home. Well, they're not going to be able to afford to buy a home, so I am building 10,000 rental townhomes for them in these are affordable townhomes that are in smaller cities. And the goal is to serve families between 60 and 85K in income by having rents between 1.5 and 2K. These are very profitable projects. I'm not allowed to tell you anything about them in this particular webinar, but I would love for you to join my mission. You're welcome to put it in chat and just say, I want to join your mission, right? If you're looking to do that, you can do that in chat. The chat is saved. At the end of this presentation, I will show you a slide that has my contact information. All right. First thing I want to show you is where's the growth? Well, in 2023, the growth states once again were Texas, Florida, right? The big growth states, the biggest winners, North Carolina and South Carolina. This is where a lot of the investing focus is right now. Tennessee, it's terrific. Idaho has been phenomenal for the last 5 or 6 years. So this list actually hasn't changed much. The biggest losers haven't changed for the last 5 years. It's always Massachusetts and California. California continues to bleed and lose population. Now for this year, interesting enough, here's the top 10 housing markets for 2024. And for the first time in the last 10 years, there's nothing in the Southeast. Why? Because Southeast markets have a huge amount of supply. There's a lot of incoming apartments, and so their rent growth is negative. And so you see some very interesting markets. You see Ohio. I never thought I'd see a list where, I'd see a city in Ohio at the top of the list, but it's there, right? In the Northeast, some of the cheaper cities in the West are there too, like Riverside and Bakersfield. So the trend is clear. The hot boom towns for the moment are not doing well. That's because of high interest rates. Let's balance this out with a second list from Zillow. Once again, the state of Ohio is ruling. So number 2, number 3, number 8, they're all the top 3 cities in Ohio. Zillow has a more balanced approach, so you do see some boom towns such as Atlanta and Charlotte, Orlando, Tampa represented in the list. It's also nice to see cities like Indianapolis in the list. One final list. This is from the Realtor magazine that's published by the National Association of Realtors. They give a nod to Atlanta as the best housing market. Amongst smaller markets, note Rogers, Arkansas, Greenville, North Carolina, and Jacksonville, Florida. Also good to see San Antonio in this list. All right, I'm going to skip past this particular list. And now I'm basically going to give you my top pick for 2024. This is not the analyst pick. This is my pick, right? My pick for the best up and coming market in the US is Grand Rapids, Michigan. And last year when I did this list, Grand Rapids was a near miss. Strong value index. It has an affordable cost of living, a very vibrant downtown, very interesting neighborhoods, lively business district. And that's why Michigan's second city is our best up and coming market. And then the best market in the US unquestionably is the Raleigh-Durham Metro. So this was our joint winner for, we also named it in 2022. In 2020, it was with Charlotte. This time it comes back on its own. The key is an exceptional quality of talent. They've got 3 world-class universities. There's a huge continued demand for talent. And this market, even though it has huge incoming supply, has continued to see rents rise. So those are some of your best markets in the US. And we do this kind of analysis. We do it throughout the year. We do 20 knowledge-driven, power-packed webinars. And you can access all of them. There's no subscription, no upsell, no fee. Nobody will call you as a salesperson. This is meant to be like a Wikipedia of real estate knowledge. Write down multifamily.com, u.com. You can see some of the webinars that are coming up. And then also here, you can see my phone number and email. Feel free to send me an email or, or give me a call, and I'll be happy to discuss potentially us working together. And then I'll be free to show you what has happened over the last 5 years with our investors, our 1,000+ investors, and what their returns have been like. And if you have any questions, I'll take the questions now. Back to Scott.
Great, Neal. Thanks for the presentation. Again, great data. One question I had, and we'll get into some of the questions that are coming in. I see one in there right now, and certainly anyone listening live, get your questions typed into the question box. We have some time to get through those. But kind of the lock-in effect that you're talking about with single family, what do you think will be the biggest? Will it simply be interest rates coming down that see us move away from that kind of effect and see more people moving? You think that's basically the primary driver right now in the residential market?
Yes, and we're starting to see that happen. So even though interest rates haven't declined, I expect the first rate cut to now be September, because the last 4 weeks, the data has been pretty weak for the economy. So I do expect that the Fed will cut in September. And so we're already beginning to see some loosening of that lock-in effect, because people have been sitting on the sidelines for a while, and some people just can't afford to be there forever. They need to move. So we are seeing that, and so inventory was extremely low, more than 40% lower than sort of the historical norm. And now in the last couple of months, we are beginning to see more homes come into the marketplace. So it's going to be like, but it's one of those things where first-time home buyers never catch a break, because guess what's going to happen? Just as that inventory increases and you start seeing some competition in the marketplace from the perspective of the buyers, well, guess what? The rates are going to start coming down in September. So we think that the market's just going to muddle along for the next 2 or 3 years, because next 2 years are a rate declining cycle. So Fed might go slow, they might go fast, but it's the general consensus is that rates are going to go in a downward direction. So we don't think prices are going to come down because rates are going down.
Question that someone brought in on the commercial real estate side said, would commercial real estate provide some interesting investment opportunities, especially if they're looking to be converted into multifamily or other types of development, assuming that the zoning would support it? So obviously, if you showed some data, commercial real estate, there are some potential issues there. Are you seeing that at all, where some space is being converted into different types of use to obviously to increase the returns and cash flow?
So a lot of talk and a very, very small amount of actual square footage, just a lot of talk. So an analysis was done where they looked at all of the empty office buildings in New York and say, what percentage of these can be profitably converted? That's very important, the word profitably, right? Because banks are not going to lend money to you, millions of dollars, to convert something when it can't be done profitably, right? So the answer was 3%. Only 3% of the office spaces in New York that are empty can be converted profitably. So we are seeing some people doing that activity. We've seen a few companies open up that are doing it, but the overall numbers, whether it's for converting hotels to small multifamily or for converting office to multifamily, overall numbers have been extremely small. I mean, they would have to be 100 times larger to move the needle.
Gotcha. With you mentioned the industrial space and the fact low vacancies, very popular. I guess like you said, real estate's a finite resource. It's more profitable for a town or community to allow for a high-rise development than it would be to allow space for large warehouses. How do you see that problem resolving itself?
I don't see that problem resolving itself. So the United States is going to need roughly 5x the space for data centers that it has today. Artificial intelligence is simply the greatest single event in modern history. So I put it right up there with the birth of Jesus and the invention of the wheel. So if you listen to what the top 5 tech CEOs are saying, right? And they're not just saying, they're doing. Did you know Amazon just bought a nuclear power plant? Purchased a nuclear power plant. Guess where their data center is going to be? Inside the nuclear power plant, because they don't want any electricity wastage because of transmission. So Amazon's saying, if we're going to basically be out of business if we don't jump onto the AI bandwagon, because everything will change. And the moment you jump onto the AI bandwagon, you realize we're going to run out of electricity and we're going to run out of data centers. So the 2 areas that you're going to see a severe shortage of in the next 5 years, number 1 is industrial, because all data centers are in industrial buildings, and the second one of electricity. We're going to run out of electricity within the next 5 years.
Gotcha. Okay, if anyone else has any other questions or listening to the webinar, please get them typed in here. I'll have Neal on for just another few moments. Yeah, I thought it was interesting too. You mentioned like the government, when it comes to interest rates and inflation, they kind of hit their targets because they force it themselves. So they're going always quote right in what they're looking to doing. What impact would other events what kind of things would, if obviously shooting for lower inflation rate, lowering interest rate, what kind of things might turn that on its head, where we're kind of headed in that direction? I think a lot of people agree that that's where we're headed. Is it geopolitical events? Is it, obviously, domestic political events? Obviously, we have an election coming up. How do you see that affecting, real estate investment, in general, maybe even in the economy when it comes to obviously our upcoming election, here in the next 6 months?
I honestly, for the next 6 months, I don't expect much to happen. Biden really doesn't have the ability to move the needle on inflation at this point. Even if he wished to, I just don't think that there's much he can do. One of the things is, I tend to bash the Democrats a lot, but one thing I don't bash them for is the Democrats do not interfere with the Federal Reserve. The Republicans do, right? So Trump is known to have very nasty public statements. You can find them on Twitter about what the Federal Reserve should be doing in terms of interest rates, but no Democrat president has ever, talked about it. So the amount of pressure, if it's there, it's subtle. And the Fed didn't even bow to Trump's pressure back in, when he was president. So I don't think that that's going to happen in a Democrat group. So I don't think that Biden has any current levers to pull for inflation. So I expect to sort of just muddle along. After November 7th, if Trump wins, we expect to see a significant increase in real estate values, because he will immediately bring back bonus depreciation. That's in his plan. Bonus depreciation tends to, flow a massive amount of money into real estate. If Biden wins, don't expect to see a reduction in real estate, but it certainly is less likely to go up. Now, in terms of where I see inflation in the next 3 to 5 years, the biggest X factor is a conflict with China. So I believe that by 2028, it is inevitable that the United States will get into a shooting war with China. When we do that, we could see inflation not at 10% or 5%, but at 100% for as many as 6 months, possibly even 12 months. So that's sort of the X factor. I call it the next black swan event. And it's less of a black swan event in the sense that we would see it coming. The China, because it's not like Russia, where Russia sort of just gathered its troops in a month and then moved into Ukraine. China, there's no border, right? There's the ocean, so you have to basically bring hundreds, if not thousands, of vessels there. So it would be a very public thing that China is preparing to invade Taiwan. We'll have plenty of notice, but we still think inflation would go completely crazy. Other than that, I don't see inflation going up for the simple reason that world growth is slowing. I think most people don't understand this. A absence of growth is also an absence of inflation, because inflation simply shows demand. If demand drops, inflation drops. So there's actually more worries about there being deflation in the worldwide economy in the next 5 years than inflation. The X factor, as I mentioned, is China. also potentially something happening to the oil supply. Oil supply can create a disruption in oil can create inflation very rapidly.
Good, well, good. Thanks for the answers. The last question we had came in says, this is being recorded, available to be rewatched? Yes. Again, all the webinars we do at Advanta, we record them, we place them on our YouTube page, we email them out to you, we can send you a copy of the slides here as well. You have Neal's contact information. Like I said, we do a lot of great educational events at Advanta. You can see on this slide too that Neal has all the education that he provides at Multifamily University as well. So make sure you visit his website. One other question that came in, I'm not sure if you can answer this one or not. It says, I'm hearing employment being cut. Are these people able to find new jobs? I guess kind of the job market. Like you said, though, I think historically the unemployment rate is fairly low.
I do expect artificial intelligence to have the greatest impact on employment that we have seen from any technology in the next 100 years. But ironically, in the first few years, the impact will be upwards. If you look at the companies that are benefiting from AI, they've gained over 2 trillion, that's $2,000 billion in stock value in the last 24 months. And I expect that trend to continue. So you should actually see unemployment get tighter. Also keep in mind, baby boomers are retiring. So the workforce participation rate is dropping. And so in the short term, I think we're going to be fine. 5 years from now, I expect to see unemployment rates start to shoot up as AI starts to replace more and more human labor.
All right, well, again, I don't have any other further questions. Again, thank you very much for your time. Again, like I said, always great information, very data-driven, backed up. We'll send a copy of the slides to anyone who's looking for them, so you can look up those charts, go back over that information for your own edification. But again, Neal, I want to thank you again for coming on and joining us today. We'll look forward to having you back on soon, talking about maybe upcoming 2025.
Awesome. Thank you, everyone. We'll see you at multifamilyu.com.